Hey guys, what's up? It's AB Trades, and today I want to talk about a little lecture slash group meeting slash I don't know what you want to call this, but it was put on by Tastyworks and Tastytrade. They put on the Futures Symposium in Houston, and they talked about mainly futures and how that can be incorporated into your trading style, as well as pair trading, so that you don't have to take on the full risk of trading futures. And I just thought it'd be interesting to go over the notes I took. And if you don't want to look through my notes, I will be linking where you can get access to the slides that they showed below. Again, a lot of my notes are from what they said and not necessarily what's on the slides, but it still would be cool to look through, so that will be linked in my description. So let's start off. So it started with a guy from SME group or whatever, which is the Chicago Board of Exchange, I think, SME, I don't know, something like that, whatever. And then it went to Pete Molmat, which is a partner or a worker, I don't know what you want to call him, a speaker at Tastyworks slash Tastytrade. He traded for 20 years on the floor. He ran a prop firm, and now he's at Tastyworks, and he specializes in futures. He's been trading, we found out, for 40 years, so that's very impressive. He said futures have many benefits, such as tax treatment, leverage, capital efficiency, 24-hour access, and huge liquidity. He says you have to have solid mechanics to protect, blah, 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 blah. So his main thing, like, he said this multiple times, and I loved when he said this because I never heard anyone else who said this besides me. He says, context is great. Fundamentals doesn't mean much. Fundamentals just give you a context of something. So, for example, if you're trading corn and soybean futures, do you need to understand the reports or the supply and demand or blah, 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 blah? He's like, not really. Context is great. I mean, it's cool to understand context, he says, but he says, price is what determines everything. I watch price action. That is what he said. And I was like, I love that because that is what I do. So it's cool to hear a veteran trader of 40 years to say, fundamentals don't mean much. It's all about price. And I was like, cool. So when he talked about pair trading, so the way that pair trading works, so let's say if a futures market, I don't know how much y'all know about futures, but with futures, they expire every single month. So each month is a different future expiration. So let's say the expected move on a future for that day is $1,500 with your exposed risks, or let's just go to 25 points. So let's just say this expected future is expected to move 25 points today, okay? But you don't want to be exposed to that whole 25% risk. So you can take on something that is around 70% correlated to it, or between 65 to 85% correlated to that future, whether it be another future in that calendar, like another month of that future, and sell that one. So that instead of being exposed to the 25 points of the move, you're only exposed to like 5%, yet you can still make the money. So if you want to think about it in terms of options, it's like doing an option spread, but on futures. It minimizes your risk. Let's see, he says, many traders don't realize the news. They hear and read, the news they hear and read has already been discounted by the markets. And what discounted means, it's already been factored into the price. What we care about is price. I prepare for big moves before reports, but I am not trading the reports, just protecting my current positions. Don't have a directional bias. Trade both sides. Don't trade in inactive or illiquid markets. It is dangerous. So make sure that there's a tight bid and ask spread. Slippage is a trader's worst enemy. Okay, and then he just wanted to show how futures can increase your buying power. So for example, if you buy CL futures, which is crude oil futures, and you want to be exposed to $65,000, so if you want to own $65,000 worth of futures, you're only putting up $3,200 for that $65,000. Now, if you want to trade the crude oil ETF, you want $65,000 worth of exposure, you have to put up $32,000 because you only get 50% margin. So I thought that was interesting, but you have to understand that when you play with margin, it's a double-edged sword. So yes, you can make a lot more, but you can also lose a lot more. He said foreign exchange He sees that there's a lot of mean reversion characteristics, and also pair trading. You can pair trade foreign exchange currencies. So, for example, if you have your Euro USD and JPY USD or something like that, and you pair trade them, which means you buy one and you sell the other. Now you have a chart of JPY. Should I say that? Yeah, in GPB. So Great Britain pound versus JPY. When you pair trade something, you can actually get rid of the USD aspect of it, which is good because he was saying if you have everything in equities and options and futures, you want something in your portfolio that is not correlated to the U.S. economy at all. So if you pair trade two different currencies, and you're eliminating the factor of the USD currency in there, thus you have a position in something that is not correlated to any of your other stocks. So like if the market goes down, that position, since it has nothing of the US dollar in it, is not heavily affected as the rest. Then we get to the main guy, Tom Sosnoff. He was the creator of the Thinkorswim platform that he later sold to TD Ameritrade. He traded on the floor, as well as he now is the owner and creator of Tastyworks and Tastytrades, I believe. He said, in an efficient market, there is no edge for bots, HFTs, which is high frequency trading, and machine learning. When he means in an efficient market, when everybody knows everything, when it's highly liquid, there's no edge that a human cannot express that a bot can. He's basically saying if it's liquid enough, a bot cannot mess with it. You can trade it and have the same edge as a bot. Now if it's illiquid, that's when you start to have problems because a bot can move that stock around. He said 99.9% of portfolios, sorry, I was typing fast, are managed passively. This means that 99.9% of people who have portfolio accounts have it managed under a different company, another firm. It's either a mutual fund or something. And he says strategic and individual investors, people who are investing their own money, they are the people who are going to create wealth. They're relying on others. They are strategists. And if you're watching these videos, the videos that I make, you are definitely a strategist. You want to see how the strategy works, how you can make wealth for yourself. He went into a few things, blah, 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 blah. He says, the art of decision making is the single most important factor of wealth creation. The most successful traders and strategists focus on the long-term accumulation of wealth. You can't build real wealth overnight or in a week. Peter, the first guy who talked that I mentioned, has been trading for 40 years. Tom Sosnoff has been trading for 30 years. He just said that to put that into perspective. They've not been trading for a year or 2 years or 10 years. They've been trading for multiple decades. Let's see. Success is a byproduct of good decisions. The University of Chicago did a study that says decision-making increases by 100% or something when you make 10 or more eBay trades, which is the same thing as making, trades in the stock market. Not important. This was also pretty interesting, which I found interesting. He said, don't be greedy. You should only be expecting to make 20 to 40% of the average daily move from the past X years to determine what to move. Okay, so to put this into perspective of a stock, let's say you are trading Amazon, and in the past, let's do something like AMD. So in the past, on an average day, it's moved 5%. Let's just say that. So advanced micron devices, something like that, moves 5% in a day. Okay, you should only be expecting to make 20 to 40% of that. Let's just go huge. Let's say you're only expecting to make 50% of that move. So if it moves 5% on average a day, and you should only be expecting to make 50% instead of that move, so you should only be expecting to make 2.5% of that. Okay, so if you have 2.5% of that and you say I want more, you shouldn't be, because your greed is not, it's dumb, because you can look at the expected move and be like, all right, this is the expected move, we have hit it, time to take profit. So I thought that was interesting. Just look at an expected move. Tastyworks and Tastytrades also has like a think tank and a research team, and this is one of their researchers what I thought was interesting. It said 66% of the time, liquid futures remain in tradable ranges. The scalping zone for futures is plus or minus 1.5 to zero point 0.5 standard deviations. Once you're outside the plus or minus zero point 0.5 standard deviation, then scalping has a statistical probability of being profitable. I don't know if y'all know, y'all do trade options, so y'all should have some knowledge of statistical probability as far as standard deviation. So standard deviation is just how much on average the stock actually moves. So between what prices that it moves on average is 68% of the time. 68% of the time the stock moves, that little graph there, that is one standard deviation each. So every time you move out of the 0.5 standard deviation, then you have a 66% chance throughout the past history of your scalping being successful. So I thought that was interesting. Since he traded also on the trading floor, he accumulates or he relates noise with money and no noise with no money. Now, what does that mean? No noise. When there was noise on the floor, that's because people were calling out like, "Hey, get me a XYZ stock at $50 or whatever," and they were all yelling because they were wanting to buy and sell stuff. So how can we take that? Don't trade anything that doesn't have huge volume. Okay, we want volume. If we don't have volume, there's no money. No noise or volume, no money. Volume, there's money. Scalping, he said, is a byproduct of understanding trading ranges and intraday expected moves. Scalping is a market awareness challenge. It is black and white. Scalping is trading, but it's an engagement tool more than a factor in wealth creation. He believed that people should just scalp for fun and engagement, not necessarily for wealth creation. He didn't think that's possible. I don't know. I disagree with that. But then again, I'm not really scalping. I'm trading a defined system. My system isn't necessarily scalping. I'm just finding the best place to enter, hopefully long-term runs. So I don't know. I could disagree with that, but he's been trading for 30 years, so we shall see. Blah, 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 blah. Lessons I learned from other people I talked to from the group. There were a lot of people there. And one is be more systematic. This guy and trading only selling strangles, he made 120% last year after he learned to be systematic. He was trying to pick direction of a stock and it never worked, so he started just selling strangles, and he did it more based on math instead of what he was feeling, and that's how he became profitable, because he became systematic. The psychological aspect, which is making money without a plan, is the trap. That is their quote. They said they were talking, and I remember this verbatim. They said, making money without a plan is a trap. So basically, when you first start trading and you make a lot of money without a plan, without a strategy, without a methodology, then you're screwed, because you're going to keep trying to trade like that even though you have no plan, and you're going to lose. And you need to learn to adapt to all markets: high volatility, low volatility, and normal. I hope y'all like this. Again, I will link the thing below, and I hope y'all liked it. Please like, comment, and subscribe. See y'all in the next video.